Welcome back, dear students. So today what we are going to see is question number 7, problems and solution for it. Okay, the calculation of payback period. So ABC Limited is considering the purchase of machine. There are two models, X and Y. Prepare a statement of profitability showing payback period from the following information. So which means they have given the cost of machine and they have given the savings as well as the expenses towards that mission. So the detailed information they have given. So now using this, we have to find out the payback period. So now, first of all, we have to see whether the cash flow is even or uneven. So what is the information? How do we find out that cash flow is even or uneven? Because see, based on the income what they earn. So here they have given a details about 1 year only. So which means it is a even cash flow only. Okay, when there is no cash flow changes. Okay, so in that case, what would be the formula for calculation payback period is nothing but original investment divided by cash inflow after tax before depreciation. Okay, so that is only. So now let us find out the what is the cash inflow in the particular year. So they have given information about the cost of project, model X and model Y, and the estimated life also they have given, and estimated savings in scrap. So savings they have given. So these are all the savings, 12,000, 8,000, and additional cost of supervision per year. So this is the expenses what they incur, additional cost, and cost in indirect material, that also they have given, and an estimated savings also they have given 150. So using this information only, we are gonna find the taxable income. Okay, and assume that depreciation will be taken on straight line basis. Assume tax rate is 50%. So here the depreciation will be straight line basis. How do we do to straight line? It is nothing but 1,80,000 minus salvage value divided by the life of an asset. So by that we will come to know what is the depreciation for every year. Okay, so now let us move to the solution. Okay, so for your calculation purpose, I have done a predefined solution table, so you can have a look on it. Okay, so let me solve it. I've shared that screen also. Okay, so calculation of cash inflow. Okay, so here particulars model X and model Y, and here savings. What are the savings we saw in the question? That is scrap. In the form of scrap, they are saving. Model X is 12,000, model Y is 1 lakh or 18,000. And next is estimated savings in wages. When during in providing wages also they are saving something. What it is, that is for model X 150. 150 into 720. So 720, it is nothing but, see, in this question what they have said that workers not required. So estimated savings in wages. We're using this model, the reduced number of workers, and what are the working hours? That is 720 per head. Okay, for workers 720 they are paying. So which means 150 workers are not needed. For one worker we are paying 720, means how much total? It is 1,08,000. And same way for model Y also it is. So total savings is 1,20,000 and 1,62,000. Okay, from model X 1,20,000, model Y is 1,62,000. Next is expenses. So next we have to see the expenses. What and all they have seen, they have said about the cost of supervision and what is the direct cost, indirect material cost we are incurring. That information they have given. So total all this. So this is a total of expenses. So how do we find out cash inflow? It's nothing but income minus expenses. So on that basis, we could find out the cash inflow is 90,000 and 1,20,000. So this is a cash inflow what they are having in this year. But this is an inflow before depreciation and before tax. So we have to find out what is we have to find out, that is cash inflow before depreciation but after tax. So let us do that. So first, before that, we have to do the calculation for depreciation. So how do we do it? Depreciation, it's nothing but depreciation formula is straight line method, means cost of acquisition minus salvage value divided by uh, life of an asset. Okay, so model X, what is the cost of acquisition? 1,20,000, and salvage value there is no 0, divided by 10. So depreciation is 18,000. So model Y is 20,000. Okay, so now first is cash inflow before depreciation and tax. It is 90,000 and 1,20,000 less depreciation. So depreciation we have calculated, right? It is 18,000, right? So that we have to minus for model X. Model Y it is 20,000. So this is after deducting depreciation, whatever value you are going to get, that is called cash after depreciation before tax. So next we have to minus tax. So 50%. So 36,000, 72,000 into 50, it is that is 6,000, and here 50,000. So this will be the cash after depreciation and after tax. But what we need a cash before depreciation and after tax. Okay, so that is the reason we are again adding back 18,000. So we have to add it back. So total whatever after adding whatever we are getting, that will be the cash before depreciation and after tax. So on that we have to apply a formula. So formula for payback rate calculation is original investment divided by annual cash inflow after tax. So original investment is how much for machine X? It is 1,80,000. So 1,80,000 divided by annual cash inflow after tax is 54,000. Okay, that's if you minus it is 3 years, 33 years, 3.33 years, and for model Y is 4 years, 2.8. So which model is best? Which gives the earliest investment? Model X. So we have to prefer model X for this case. Okay. Thank you so much. We'll see you in the next question.